Hello and welcome to today's webinar, Startup Seed Funding from Bootstrapping to Equity Financing, presented by Early Growth Financial Services and Fenwick and West Law Firm. My name is Patty Montoya and I'll be your moderator today from the Early Growth team. I have a few quick notes before we get started. The webinar will last about an hour, and that includes time at the end for questions. So feel free to type your questions into the control panel and we will answer them in between slides. The next thing to note is that this webinar will be recorded and sent to all the registrants with the slide deck within 48 hours. You can also find the recording and all of our recording on our YouTube channel, Early Growth. Now, before I pass this off to our speakers today, I'd like to tell you a bit about Early Growth. Here's a quick description of what we do. We are an outsourced finance and accounting firm. We work with early stage companies, helping them with everything from day-to-day accounting to financial forecasts to taxes and valuations. And this is a little bit about Fenwick. Jonathan, do you want to take over?
Sure, happy to. So thanks everybody for joining us. My name is Jonathan Sagot and I'm a corporate attorney at Fenwick and West, specializing in startup and VC representations. About 75% of my practice is spent on the company side, and that's representing companies from formation through all their financings, whether that's the friends and family pre-seed rounds that we're going to be talking about today, and seed rounds, all the way through their lettered financings, and then helping them exit, whether that's doing an IPO or helping them with an M&A transaction. Fenwick and West is one of the original Silicon Valley law firms. Started in the 70s, and we're a full-service law firm really specializing in tech and life sciences. And you can see some of our most well-known clients there.
And this is Jonathan from Fenwick and West and Sirk. Do you guys want to give a little introduction of each other?
Yeah.
Of yourselves.
Sure. I think Jonathan kind of mentioned himself. Hi, everyone. This is Sirk Roh from Early Growth Financial Services. I'm a consulting CFO. I've been with the firm for about 6 years, helping small early stage companies grow to where they are able to hire people internally. So you've seen a list of kind of what we do, but we're thrilled that you guys can spend a little bit of time with us this afternoon. And without further ado, unless Jonathan, you have anything more to add, we can go ahead and get started.
Sounds good. Let's get started.
Great. Okay, fantastic. So this is kind of what we're going to cover today. We're going to cover bootstrapping. So obviously this presentation is about financing your company, right? And so we'll talk about the different phases and the different vehicles that we have to do that. And some of the things that we'll be talking about is bootstrapping, which we'll cover the next slide. We'll talk about going from bootstrapping to getting outside investment, both from friends and family, which kind of tends to be that first outside money that you might get. And then also on to the next, what I would call institutional investor round of financing, whether that's through a convertible debt or through an initial equity round of financing. So we'll talk about that. We'll talk a little bit about kind of what we want to do in terms of preparation to getting investment capital from the outside. And as I mentioned, we'll talk about the different ways that we can structure our first, and here it should say institutional investment round, whether it's through convertible debt or whether it's through some sort of a series seed or a safe preferred stock offering. And then we'll touch upon maybe one or two sample term sheets, and Jonathan will kind of go into more detail about what you can expect to see on some of those types of transactions. Okay, and I think, I don't know if Patty mentioned it, but please feel free to go ahead and type in any questions that you have along the way, to the extent that there are questions that it makes sense for us to answer as we're talking throughout the presentation. We certainly will do that. Otherwise, we'll try to leave some room at the end of the presentation to answer any questions. Okay, fantastic. So bootstrapping. So bootstrapping is kind of the first thing that we're going to be doing as we get our company started, right? And by bootstrapping, we basically mean funding it ourselves, the entrepreneurs funding it ourselves. So in addition to in addition to the time and the sweat that you're going to be putting in to get the company started, that obviously there will be some money that's going to be needed, right? In terms of setting up the company, initial expenses. You may or may not be paying yourself and partners money, but in any case, you're going to need to put in some amount of capital, and usually that's through our own resources. And so some of the advantages of bootstrapping are that you're really, really focused, right? You know that that this is your money, your investment that you're making. You're going to reap the benefits of all the work that you're putting in. It really allows you to be really, really focused on execution, right? Whether it's product development, whether it's a combination of product development and customer acquisitions. This allows you to really focus on yourself and the company, because there are no outside investors at this point, right? So there's no reporting requirements. People aren't hounding you for updates on what's happening with the product, what's happening with financials, how much cash do we have, and all of those things. And because of there's no outside investors, obviously there's no dilution. So at this point, you own 100% of your company. And obviously that's another benefit at this stage. We talked a little bit about the independence, the fact that you're able to do things on your own. You don't have to answer to anyone else other than maybe yourself. And if you have a partner or two, then obviously as a team, you're making decisions for the benefit of the company. And then the one kind of caveat as we're kind of doing this and as we're really getting started, and I think Jonathan will talk a little bit about this as well, but we just want to make sure that we want to keep our personal finances separate from our business, right? There's multiple reasons for that. Jonathan can talk a little bit about the legalese of it, but obviously from a financial perspective, we want to keep all of our transactions separate so that we can keep our records properly for tax purposes, as well as when we start putting together financials, statements, and plans that we're going to go out to investors, that we want to be able to show exactly what has been spent. So Jonathan, could you also add, some of the legal reasons that we do want to keep personal finances separate from business?
Absolutely. And Sirk, that was really great. Thank you. The main reason that you want to be keeping things separate, it's this concept of respecting the formalities of the business. And why is that important? Well, let's take a step back, right? Why do you want an entity in the first place? You want an entity because then you get the protections of limited liability. And what is limited liability? Limited liability is a principle under the law that says if you are operating your business through a validly formed legal entity, then your exposure in the absence of fraud, okay, if you're defrauding people, all bets are off. But in the absence of fraud, your exposure when operating that business on a personal level is limited to the amount of money that you've put into your business. So if you put $1,000 into your company to get it off the ground and someone sues you for $1 million, and you've done everything the right way, which includes keeping your personal finances separate from the business finances, right? That's one of the ways that you respect the corporate formalities. You treat this as a real entity. Then even if you get sued for $1 million, you're only at $1,000, right? That's the idea, and that's why having an entity is so important. So when do you want to put an entity in place, right? We get this question from founders all the time, like, well, when do I need to form an entity? Well, really, the best time to form an entity is once you have enough of a business idea that you want to start entering into contracts, or you want to start selling product, or you want to start hiring people. Anything where you could have any sort of exposure to third parties, that's really the moment when you want to form an entity. So usually what I tell people is if you're past the stage where you have more than a slide deck, right, where you have more than just an idea that you have been talking about informally with a couple of people, and you're really ready to see if you can do something with this, that's really the point at which that you want to get an entity in place. Now, if you don't respect the corporate formalities, right, the term under the art here, the term of art under the law is called veil piercing. And that means that the corporate veil, which is what protects you, that's that limited liability protection, can be pierced if you're mixing if you're mixing your personal finances with the business finances, or if you're not actually keeping good records as a corporation or as a limited liability company. And that's what we're trying to avoid. But the good news is if you work with good legal counsel who knows what they're doing, this is all the sort of process stuff that we think about all the time to make sure that it's taken care of.
Fantastic. Okay, so let's just move on to the next step, which is how do we go from the bootstrap stage to the next level, right? Where we are now looking at bringing on outside investors and taking money from other people. So the first, the next step is really friends and family, right? So this is now where you've put a little bit of money into it. You've started the company. You have an idea. You're working on your product, and you really want to now start to spend a little bit of money, and you're going to need more outside investment. But it's probably still too early at this stage, and we haven't made enough progress yet to actually go to outside investors. So this is kind of where you go to your friends and family, right? And you say, hey, listen, I got this business, I got this venture started. I got, I think really, really great things about the future of this company. I would love to kind of, get you involved in the company by investing a little bit of money. And so, obviously this is going to be, unless you have, you're fortunate enough to have very, very wealthy family and friends who can put a lot of money into it. You're probably talking about a small amount of money here. So it's a pretty small investment to get started. Obviously as you're doing this, you're going to need to be a little bit formalized in terms of your process. You're going to want to put together some documents that talks about, how much money is being invested, how it's going to be repaid back, whether it's going to be repaid back or turned into equity in the future, things like that. So you just want to make sure that everyone understands what they're getting into. And the biggest part about this is obviously be transparent about risks, right? Because unlike a regular investment that someone might make in the stock market, in a stock of a public company, for example, this is usually going to be kind of like either a big reward if you're successful, or in many cases, unfortunately, an entire loss of their investment, right? So it needs to be money that is risk money, risk capital that can be put in, and even if your friend or your family member loses the entirety of their investment in the company, that's still going to be acceptable and palatable. Because obviously, the last thing you want is for money to get in between you and your family and friends. It's a horrible situation to be in, and it can be mitigated by making sure that they understand what the risks are. And then finally, and I'll let Jonathan take over in terms of what happens when you start bringing in professional investors. And Jonathan, could you also just touch upon kind of the accredited investor definition and what that means in terms of taking on friends and family money?
Yeah, of course. So to take a step back, you're dealing with these smaller investments, right? From your wealthier friends and family. We're talking, probably less than $500,000. And this, could be going on while you're also maybe still continuing to bootstrap in the background. But usually once folks are going to go out and try and raise money, you've sort of like moved from the bootstrapping phase to like, we're going to go out and use other people's money phase. So you're looking at less than 500 grand. You're going out into the world with a convertible security, most likely of some kind. And that's a safe or a convertible note. A safe is a simple agreement for future equity. We'll talk about those more a little bit later in the presentation. And exactly as Sirk said, these people, you have to make sure they understand they're buying a lottery ticket, right? They're basically lighting this money on fire. Now, hopefully not. Hopefully your businesses are all wildly successful. But the mental space they all need to be in is that this investment has a ton of risk, and you need to be really upfront with them about it. Now, a lot of founders think that, particularly first-time founders think, well, it's just friends and family. Right, I don't really need to worry about anything else. I downloaded my safe from from the Y Combinator website, and I went out and had it signed, and they gave me money. Great, I don't have anything to worry about. The problem is that these are securities under the U.S. securities laws, and the general rule under the U.S. securities laws is that you need to register every securities issuance, which means you need to file these very detailed filings, like they do when they have an IPO. It's called an S1. Unless you can find an exemption from registration under the Securities Act. The good news is that there are a few exemptions that we use all the time in the startup and VC world. And the main exemption that we rely on is Regulation D. And under Regulation D specifically, we rely on something called Rule 506B, which says that if you are raising money from accredited investors, then that's an exemption from registration and you don't have to register with the SEC. You do have to file something called a Form D with the SEC, but that's, it's a couple of pages and it just talks about the amount of money that you've raised and the name of the company. And that's basically all the information you need to include there. So what is an accredited investor? An accredited investor, now the rules are different for individuals versus for entities, but let's focus on individuals because that's really what the main focus in a friends and family round is going to be. An individual needs to have at least $1 million in net assets, and that excludes the value of their primary residence. So they got to have $1 million sitting around in stocks or, in cash in a bank account, things like that. And it can also be satisfied if someone has made at least $200,000 in wages, right? They're sort of the salary that they're getting for services in the last 2 years, and they expect to do the same this year, or in combination with their spouse, they've made $300,000, and you can mix and match. So it could be, you say you got married in the current year, and you're looking for a new job or something, and you're not going to make the 200,000 threshold, but together with your spouse, if you're over 300, you would still qualify as an accredited investor, so long as you had made at least 200 grand in the last 2 years. So it's really important when you're trying to figure out if a friend or a family member can invest in the company, whether they're an accredited investor. And legal counsel can give you, a very short questionnaire for people to fill out. And the bottom line is, if your aunt or uncle wants to give you $5,000, but they're not an accredited investor, it's not worth the legal trouble and headache to take their money while you take the securities fraud risk of them maybe filing a claim later and saying, oh, I had no idea that this was such a risky investment. If they're an accredited investor, you're not really going to have to worry about any sort of claim like that. Again, assuming you're not actually engaged in any sort of fraud.
Fantastic. Thank you, Jonathan. That's great. And so now, let's talk about, so let's say we've kind of got to that stage. We've raised some friends and family money. Everything's been papered properly. Everyone kind of understands the risk. We've taken on some of this extra cash. We've made a little bit more progress. Maybe we've hit some milestones in terms of product development or customer acquisitions or whatever the metrics that we really want to use to talk to professional investors. And now we are kind of starting to think about, okay, we're ready to take this to the next step, right? Maybe we've done some market research. We know that our product or our service is going to be well received in the marketplace, and we really need to take on some bigger amount of financing to help the company get to the next level. And so now we're going to be starting to talk about, talking to professional investors. And here, at this stage, we're talking about both angels and VCs. I think for the most part at this stage, you're probably going to be talking more with angel investors. But the main difference between angel and VCs, and they're starting to, in terms of effectively from our standpoint, from an entrepreneur standpoint, there may not be that big a difference. I mean, they start kind of overlapping each other in terms of amounts, but angels tend to be smaller. They invest their own money, right? So this may be a wealthy individual who likes investing in small companies. It may be a tech entrepreneur who made it big, and now he's helping to fund other smaller companies. It may be a group, right? It may be a group of wealthy individuals who are pooling their money together to put together a fund that will invest in companies. VCs, on the other hand, are really more institutional. They get their money to invest by raising it from outside, right? So they go to big pension funds and other big wealthy investors, raise money from the outside, pool all those investments, and then as a group or as a company, they will invest in companies. VCs tend to be bigger. They tend to write bigger checks. They tend to, follow along a little bit later in the investment cycle. So angels might invest in the first, maybe the second round of financing. VCs are probably for a little bit later stage, or if they get in early, they might want to go along a little bit longer than us. We want to make sure that we are really thinking through kind of the planning of how much are we looking to raise? What are we using that money for? And really being able to tell a story, right? To be able to say, hey, look, this is the story we have. This is why we think we're going to be a great investment. And we want to obviously be able to communicate that to angel investors and or VCs to the extent that you're going to be going to talk with either one of those. And really, when I say that it needs to be able to, we need to be able to tell a story of what we're trying to get the investor to invest in. We're talking about things like, okay, how much money do we need? What kind of milestones are we trying to reach with the money that we're trying to receive? In most cases, it's going to be a matter of if we're the kind of company that can raise outside investment from institutional investors, we're probably looking at multiple rounds of financing, right? And so we need to be able to tell that story about how the company is going to grow, what milestones are we going to hit with the money that we're going to receive, what kind of a long-term roadmap do we have in terms of product development, market opportunity, financials, all of those things. And all of that really has to come together into basically 3 documents, right? So the 3 documents or 2 documents and one message. The first is an elevator pitch, right? So this is the 2-minute, if you're stuck on an elevator and someone asks you what you do, you need to be able to really, really quickly and effectively communicate what the company's about, what you're doing, what your vision is of the company, and really get someone excited about that opportunity. Right. The next thing is the executive summary, which is a 1 or 2-page document that has a little bit more detail. Probably, has the current team, has the market that they're going after, a little bit of a description about the solution that we're offering, why we're different, what the exciting investment opportunity is for a potential investor. And that's to kind of whet the appetite. And that's probably the first thing that you're going to be sending out to anyone who might have an interest. And then the final document, and the big one, is kind of the pitch deck, right? So this is the 10 to 12 slide deck, PowerPoint presentation that will be presented to investors if and when you get that opportunity to make a pitch to investors. And here, there's tons of examples online that you can find for both executive summaries and pitch decks, and we encourage you to go out and look for examples of that, because that's not really what this presentation is about. Jonathan, do you have anything to add to that?
No, I thought that was really great.
Fantastic. So now I think we're going to go on to moving forward to how we're going to be doing this initial institutional round of investment, and for that, I'll let Jonathan take over.
Great, thank you, Sirk. So, years ago, there used to just be this concept of a seed round, right? Where basically people would go out and raise money to validate an idea or develop a minimum viable product. Today, really the seed market has fragmented, and you have this concept of pre-seed and then seed. And really the instruments that you use in the pre-seed round, right, which is also really where your friends and family are going to take place. But there certainly are going to be times when angels and even very early stage VCs might also invest. It's really when you're looking at that, that sort of 500,000 or less, though sometimes it can be as much as $1 million in the pre-seed. And then really the seed financing, which we're going to talk about now, is really that there are 2 ways to do it. You have this convertible security, okay, and that's a safe or a convertible note. And a convertible security is a piece of paper where somebody's going to invest in your business. And when they invest in the business, this piece of paper says that they get something in the future. It's a right to convert into a series of stock that in many instances does not yet exist. But the convertible securities, as you'll see, also have a repayment feature. And then you have this concept of Series Seed. And so for convertible securities, that's really if you're raising, call it less than $2 million. And Series Seed, that's if you're raising more than $2 million. And Series Seed is a priced equity round. So it's preferred stock that you are selling to somebody for a fixed price. So let's talk about the differences between these 2. All right. So the main difference between a convertible security versus Series Seed preferred is that with a convertible security, it is challenging to know upfront how much of the company you're giving away. And the problem with these instruments, particularly the SAFE instrument that's out there, the SAFE's very easy to access. It's available on Y Combinator's website. It can be very easy money for founders, and founders can get, sort of addicted to easy money. What I mean by that is, all you do is you download it from the website, you go out and you get somebody to sign it, and you think you're done. And you can raise a lot of money doing that. The problem with that is, though, when you get to your first priced round, once the business has had some success, all of those safes are going to convert into your first priced round. Let's say it's a Series A. And so they're all going to convert into the Series A, and you're just going to get, massively diluted if you're really not careful with how you're using these instruments. As long as you keep it under 2 million, generally speaking, if you follow, what I'm going to give you is the market terms here for the caps and the discounts, you're probably going to be fine. But really the thing to remember is exactly what Sirk said. When you're thinking about, should I take another $100,000 or another $200,000? Really what you should be asking yourself is, what does my company look like if I take another $100,000 or another $200,000? Am I going to be able to hit a new milestone? Am I going to be able to really increase my valuation? Or is it just going to make me feel a little bit better because I have some more money in the bank? It's okay if it's just going to make you feel a little bit better. And I don't want to dissuade you from raising money on that basis alone, but it can be very easy to just say, oh, another 100,000 won't hurt. Another 100,000 won't hurt. And pretty soon you've given away, way more of the company than you actually realize. Sirk, I didn't know if you wanted to jump in on that.
No, that's exactly right. And we really encourage you to think about taking on money, and obviously doing the absolute most and best that you can with the money that you have, because the less you take and the more you can do with the money that you have, the better off you're going to be long run.
And we can just go back to that last slide for a sec. So other things to keep in mind about the main differences. As I said, convertible security, you don't know exactly how much you're giving away. You can model it, but you're not actually going to be sure until you see what the round looks like that the securities would convert into. For Series C preferred stock, you know exactly how much of the cap table you're giving away. Convertible securities are thought of as faster and cheaper. I think that that's true. Series C preferred is a simpler version of a priced equity round financing than what would be considered a Series A. There's fewer documents involved, and it can be relatively inexpensive, but only if you're really going to stick to the forms. You can do some modifications of forms in convertible securities and still come in, less than a priced round. And there's just more to negotiate with a priced round. There's just more terms, as you'll see. And so as a result, it just ends up taking a little bit longer and a little bit more expensive, but certainly Series C is much faster and cheaper than Series A. So let's now talk about some convertible promissory notes. So as I said, we're going to talk about notes and we're going to talk about safes. Let's talk about notes first. Notes are debt. So let's understand that up front. Okay, this is a debt instrument, which means if you fail to repay it on the maturity date, there is a theoretical risk that an investor could put you into bankruptcy, right? If you can't afford to pay it. Now, is an investor going to do that? It's highly unlikely, right? Investors, as I said earlier in the presentation, they are buying a lottery ticket, right? And because they're buying a lottery ticket, it's not going to be in their interest to put the company under, right? They're looking for a 20x return. And so, usually what happens when you hit the maturity date is that you have to have a negotiation with your note holders to extend the maturity of the note. Sometimes they may ask for something, if they're going to do that, maybe they want a little more interest, or maybe they want some better terms on the conversion. But often what happens is nothing. You just blow through the maturity date and nobody even has a conversation about it. Many note holders are invested in lots of companies and, don't set calendar reminders for when their notes are going to mature. So it really depends by investor. The other terms to keep in mind here are sort of the amount of money that you're going to raise, which we already talked about, interest. So the interest rate is typically 4 to 6%. It can go as high as 8%. Now you don't actually pay interest along the way. It just accrues and it increases the principal balance, which will eventually convert into preferred stock or will be repaid in a change of control or at maturity, as we'll talk about in a second. And then there's the maturity date. Maturity is typically going to be somewhere, 12 to 24 months. You should think of it sort of the way you would think of runway for a round. Remember, when we think of a round, what we mean is that all of the investors are investing on the same terms, right? So your seed round, if you're raising $2 million, everybody's going to be investing on the same terms for that. And that would be considered a round. You can have multiple rounds within a seed. So, you could do one note with, a lower cap and then another note 6 months or a year later at a higher cap. But we're trying to keep things a little simpler here. Some VCs are going to insist on 12 months. They don't like having notes outstanding for longer than that, but 18 months is really fair in market. So you shouldn't be afraid of asking for that. Again, because this is debt, it's going to come ahead of the equity in a liquidation. So if you're selling the company, or you are going bankrupt, the note holders are going to have a right to be paid. They're unsecured creditors right before the equity holders get paid. A couple other terms to cover very briefly. There's this concept of a qualified financing. A qualified financing is a financing that will trigger an automatic conversion of the note into the equity security that's offered in that financing. And it's a qualified financing because it has to be of a certain size. Usually the way we figure out the size of the round that triggers an automatic conversion in a qualified financing is we take the total amount of notes you're raising and we double it. So if you raise $1 million in notes, then your qualified financing threshold will be $2 million, which means you need to raise $2 million in new money in order to trigger an automatic conversion of the notes. Most notes will also have an optional conversion on a non-qualified financing. So using my example before, if let's say the threshold was set at $2 million, but you were only able to cobble together a price round at $1.5 million, then your note holders will have the option to convert into that round, but they're not required to do it. The last thing here is this concept of a kicker payment. And so this means if you sell the company before the maturity date, right? So, that would be a very unusual set of circumstances, but it certainly happens. What you're telling note holders is that, again, they're in it for the 20x return. You're saying, well, obviously if I'm selling, within 12 to 18 months, after I've issued my note round, you're probably nobody's probably getting a 20x return. But at least what you're telling people is that you're going to give them some multiple of their principal amount. It's usually 1.5 times, right? So they'll get, 1.5 times of their principal, and then they get their interest on top of the original principal. And that's to compensate them to say, look, I know it's not the 20x return you wanted, but it's still a really healthy return in the unlikely event that we sell the company. So now we're going to run through a term sheet, and I'm going to tick through each of the points here, and to the extent that I didn't talk about certain things in the last slide, I'm going to cover them here. One person actually raised an interesting question, and I just want to flag it before we get into it. The question is, if I raise a round of convertible notes, does the founder still have 100% control? So it really depends what entity structure you're using. Let's assume you're a Delaware C Corp. Most venture-backed companies are going to be Delaware C Corps. And, so with that, you're going to have a board of directors, but it could just be, if you're a single founder, it could just be the single founder. One of the benefits of convertible note financings done at least on market terms is that your note holders don't have any control rights. They don't get to tell you what to do with the business. Their rights are governed purely by the contract that they've negotiated. They don't get a board seat. They don't get a right to consent if you're going to sell the business. If you sell the business, their protection, as we talked about before, is they get this kicker on a sale, right? So it's an economic benefit that they bargain for. But let's now talk about through the balance of this. So here, we already talked about what a qualified financing is. I want to focus on the conversion metric here, the two components of what happens potentially if the note is going to convert. And here we have this concept of a discount, and we have this concept of a cap. So how does this work? Here you have the discount. It's here you say it's sort of 80% of the per share price in the qualified financing. So what does that mean? That means that you're looking at a discount of 20%. So how do you think about this? You say, well, if you're selling stock to your Series A investors at a price of $1 a share, and there's a 20% discount, that means note holders are getting to invest in the same round where they get the same security, but they are only paying 80 cents a share. So it's like going to a department store and buying something on sale. That's the way to think about it. Discounts are generally 15 to 20%. Some can go as high as 25%, but 15 to 20% is perfectly market. Now let's talk about the cap. The cap says that, well, let's ignore the discount price for a second. And the cap says this is the maximum pre-money valuation that the note holder is agreeing that they could invest at. So if, let's say, you're doing a cap at $5 million and your pre-money valuation in your Series A round in which this note is going to convert is $10 million. Okay, that means that the note holder is they're not investing at a $10 million pre-money valuation. They're investing at a $5 million pre-money valuation, which is a really, really good deal. The way that the discount and the cap work together is what happens is the note holders get whatever is going to give them more shares in your company. So it's whatever gives them the better deal, either the discount or the cap. So the easy way to think about it is, if you're around $5 million, which is, in your pre-money valuation of your A round, in our example, it's going to be at the discount price. Once the valuation starts, the pre-money valuation starts to go above the cap, there's a certain break-even point, and then after that, they're better off converting at the cap price. You could also think of the cap as producing in a higher, quote, effective discount, if you will, right? So if it's $5 million versus, a $10 million pre-money valuation, it's almost as if they got an effective discount of 50%, right? Just to think of it in sort of broad terms. So what's market for a cap? Market is going to be for a first note round. Okay, so this assumes that you really haven't done too much in the way of fundraising before you do your note round. You're probably going to be somewhere in the neighborhood of 4 to 10 million, and usually initial caps are going to be 5 to 8 million. Why are they in that range? That's just the way that the market has evolved. And really where you're going to land is going to depend on, are you a first-time founder? How much traction have you got in terms of overall revenue? And how excited are investors about you? If you're a really hot company, in a really hot sector, then you're probably going to be able to command, as high a cap as you'd like. It might even be north of 10. But if you're in a sector that really the market is pretty down on, and you're, hard for you to raise money, then you'll be at the lower end of the range. So we already talked about the convertibility on a non-qualified financing and a sale of the company. So let's talk about prepayment. Generally speaking, you aren't allowed to prepay these notes without the consent of either the note holder or a majority in interest of the note holder, which means a group of note holders that hold the majority of the outstanding principal amount. Why is that? Well, again, this is debt, but everybody is hoping that the security will convert into preferred stock. If they get repaid early, that's viewed as sort of a loss for them, right? They would have hoped that they could have deployed their money in a way that would have a higher return, because all they're really getting the benefit of is the interest. So next I want to talk about closings. Generally speaking, you will have some time period to fill out your round. I mean, here we list 6 months, and that's really the sort of longest window of time that you would have to fill out the full round. Usually you're going to have 90 to 120 days. And the reason that we have a limited window is your note holders aren't going to be very happy if you have the round just generally open for a year, because the hope is that you're a very different company 12 months after you've started to take, money from note holders. Right. So it's not fair to the note holders who were investing in January, to have people coming in at the same terms in December, right, 12 months later, because the company should be worth a lot more at that point, at least theoretically. So let's go to the next slide. So let's talk about safes. Talked about them a number of times already. And may have given you the sense that I really don't like safes. And I'm fine with safes. I think the main problem with safes is that it's really not clear, how they're supposed to be treated for accounting purposes or for tax purposes. Y Combinator, who developed the safe, has taken the view that this is a convertible equity instrument, but the IRS hasn't, come down and said what it is yet. And accountants are, to the extent they are even willing to take a position, it's that they aren't really sure how to account for it. So all things considered, if you really had a choice between a note and a safe, if you've got good legal counsel, I'm perfectly comfortable and would prefer you using a note than a safe. But look, safes are used all the time. It's a suitable instrument. The market understands them, even if the tax authorities and accountants really don't understand them. They are easy to use and abuse, like we talked about before. And let's talk about how they're a little bit different from convertible debt. So unlike a convertible note, there's no interest rate and there's no maturity date. So that makes them, at least in a vacuum, a little more company friendly. They have a cap and a discount feature, though Y Combinator redid the way that safes work in September of last year. So the cap works a little bit different now than it did before, but it's pretty much the same thing. Discounts work exactly the same, and some safes also have something called an MFN, which is a most favored nation provision. And this means that if you raise using a safe, like in January at certain terms, and then in February you raise a safe with better terms, the person who invested with the safe getting the MFN automatically gets the benefit of the better terms. So we want to stay away from MFNs if possible, because it limits your ability to, basically negotiate new deals with various investors. At the same time, though, you don't want to be in a situation where you're just cutting different deals with each of your investors. Then you create a securities fraud risk, because investors can be saying to you, wait a second, you gave so-and-so this deal. If I had known that, I never would have invested on my terms. So that's not an argument in favor of an MFN. That's an argument in favor of why you should be doing things as rounds and being very thoughtful about how much money you're going out to the market and asking for, and saying, let's get all that money from the same people on the same terms. There's also this concept of pro rata rights, which basically in a SAFE will say that they have a right to maintain their equity ownership in the company in future priced rounds, so in a price round after the round in which they convert. Our view on that generally is that, look, who pro rata rights are going to be negotiated when you get to your first priced round, so it's far better to leave that negotiation for the priced round than it is to sort of promise people pro rata rights, you know, up front in a SAFE round when you have no idea what the future is going to bring. Someone asked a question about what's the difference, you know, for founders if you're doing a SAFE and a note, you know, on basically the same terms. You know, the differences are exactly what I've walked through. First, you're not going to be able to figure out how to treat the SAFE from an accounting perspective or from a tax perspective, whereas everyone will understand how to treat the note. On the other hand, a note has an interest rate and a maturity date, which the SAFE doesn't have. So, you know, maybe it's not quite as company favorable as the SAFE, but ultimately the interest is so low and the maturity date is not really a meaningful component of the instrument that I don't really think there's all that much of a difference. It's just a question of really what are your investors going to be willing to use. I found that folks on the West Coast tend to be very comfortable with SAFEs. On the East Coast, it's more of a mixed bag, and there are a lot of investors who are still very much just against SAFEs, and they want to just, you know, they're only really comfortable investing in convertible notes. So for the most part, it almost doesn't matter what you want as a founder. A lot of it's going to be dictated by your investor preferences, particularly if you have a lead investor in the round where you're using a convertible security. So now let's go to the next slide, and we're going to talk about Series C preferred. So going through a few terms, pre-money valuation. So how is this negotiated? Pre-money valuation is not a statement about, you know, the intrinsic value of you as a founder or your company. It is merely a question of what percentage of the cap table are your investors going to get based on the amount of money that they're putting into the company. And generally speaking, you know, when you get to your first priced equity round, you don't want to be parting with more than 15 to 25% of the cap table, right, that you're giving to your new money investors. That's the idea. There are a lot of things, though, that are going to inform pre-money valuation, and it's very similar to sort of how beneficial the terms are to the founders when you're setting your caps and your discounts in a note round. And that's sort of what sector are you in? Are you in a really hot sector? You know, what sort of traction do you have in the market? Maybe what have, you know, your competitors done, you know, recently? Like what are the comps? Though I'll tell you that, you know, comps are going to be less meaningful when you're sort of in the earliest stages. You're also going to have to negotiate at the term sheet stage what the size of the available option pool is going to be. And the reason for that is because investors want to know that, again, they're saying, okay, I want to own 20% of this company, but that assumes that you have 10 to 15%, you know, available to grant to future hires in that option pool. And investors, your new money investors, aren't going to want to be diluted based on the amount of money, based on, the equity that's going to folks who are receiving options. So generally speaking, you're going to be looking at a 10 to 15% option pool. The way to negotiate the size of the pool down is to talk about what your hiring plan is. And if your hiring plan doesn't necessitate you know, parting with 10% of the cap table, then that's the conversation you should have with investors. So generally speaking, that's going to be much more effective to getting you down from 15 to 10% as opposed to below 10%. Most investors just think that unless you're a repeat founder, that you just, you know, it's got to be at least 10% because that's just about what everybody needs at the outset. The company's going to have to give, you know, some basic reps and warranties about the cap table, about some material contracts, and about them not having any sort of, you know, bizarre liabilities. But the reps are easy to give, and it's not a difficult disclosure exercise to the extent that you need to disclose any exceptions to the reps. There are very few closing conditions. But generally speaking, you know, Series C preferred, you'll have a negotiation around board structure. It's usually going to be a 3-person board where there are going to be 2 directors that are appointed by the founders or the common stockholders, and then 1 director for the Series C stockholders. So let's talk about a few other features about Series C preferred stock. So these are really the features of the stock itself. So again, this is preferred stock. So it has a liquidation preference, and a liquidation preference means that they have a right usually to receive either their money back or whatever they would get if they converted to common stock, and the conversion is usually on a one-to-one basis before the common stockholders get anything. It's a preference because their right to receive that as the Series Seed investors comes ahead of the common. And what's market in a Series Seed is a non-participating 1x liquidation preference, which is just what I outlined before. If it was participating, it would mean that not only did they get their money back first, but then they also participated with the common. That's completely unfair, and if an investor insists on that, you can tell them to go pound sand, because that's just not appropriate in a Series Seed round. Other things that are going to be standard features of a Series Seed round is there aren't going to be what we call price-based anti-dilution protections. This means that usually when you do a Series A round, you have broad-based weighted average anti-dilution protection, which protects investors if you're going to do a down round. It says that if they do you do a down round after the A round, that's going to be dilutive to your Series A investors, and so they say, well, look, I want to be made whole on that for the risk that I'm taking. And they get their conversion price adjusted. It doesn't get adjusted all the way down to what the investors would be getting in the down round, but they sort of meet in the middle with broad-based weighted average. If a Series Seed investor is really insistent upon this in a Series Seed round, you can give it to them, because the likelihood of you doing a down round after your Series Seed is extremely low. If you're in a position where you're doing a down round, your company is just probably not going to be able to actually succeed. There are no redemption rights. We talked about the board seat before. Usually there is, there's one director on the board. There are very limited protective provisions, and they have normal voting rights on an as converted to common stock basis. There's no preferential dividend rights, which means that they just get dividends, when and if and as declared by the board. They'll get them pro rata with the common stockholders. The two protective provisions that the Series Seed investors really insist upon, and this is perfectly fair, is they want to be able to approve a sale of the company, and they want to be able to approve your next funding round. Those are the sort of two most basic approval rights, and those are a feature of Series C preferred stock. So next, let's spend just a moment on the contractual rights. Again, these are all slimmed down from what you would normally see in a Series A financing, because Series Seed is again, a way to sort of simplify the priced equity round. The most important feature in these contractual rights is this first bullet point here. And it's this right that the Series Seed stockholders have to get the same rights that the company gives to the Series A stockholders. So what does that mean? So from a contractual perspective, usually you're not going to have any registration rights with Series Seed, as noted on the slide. Registration rights would allow the holder of those rights to force the company to register the securities so they could be sold publicly. You're not going to do that in a Series C because it's way too early. There's no need to do it. It is a standard feature, though, of Series A, B, and C financings. And so the compromise here of giving these Series Seed holders slimmed down rights is to say to them, well, look, you're going to get the same rights that the Series A stockholders get from a contractual perspective, which means if the Series A stockholders negotiate for registration rights, and they will, you Series Seed holder will also be able to have similar registration rights. Sometimes you'll see this right of first offer on future financings. This is a pro rata right, like we talked about earlier with safes. If this is going to be given, it's usually reserved for major investors, what's called a major purchaser under the Series Seed parlance. Major investor would be the parlance under the NBCA docs for Series A financings. And a major investor or a major purchaser is someone who's put in a lot of money into the round. So if you're raising $200,000, it would be someone, if $2 million, it would be someone who's usually invested at least $250,000, and ideally someone who's investing $500,000 or more. This is to encourage people to put more money into the round because they get certain special rights. There's limited information rights, and again, these can be limited to just major purchasers. They'll be usually quarterly and annual unaudited financials. There's something called a drag along for smaller investors and for common stockholders. It is optional, but we would usually recommend that this get included. And what this says is that if the board and a majority of the Series Seed and a majority of the common stockholders approve a sale of the company, that everybody else in the cap table has to go along with it, assuming it's a typical kind of deal. Everybody's getting the same consideration. Nobody has to take on any outsized liabilities from the sale. If it's the sort of standard M&A transaction that you would expect in the VC-backed space, then everybody has to go along with the deal. There aren't any sort of company covenants surrounding, insurance or doing anything else post-closing, though usually if you're getting to a Series seed round, it's a good idea to have insurance, including directors and officers or D&O insurance. And there's no concept of co-sale rights, meaning if one of the common stockholders wants to sell their stock to a third party, usually that a preferred stockholder doesn't have the right to tag along in that sale and to sell with that common stockholder. So the Series Seed docs are available at seriesseed.com. They were actually created years ago by Fenwick and West, but they've become pretty widely accepted in the market. You'll also often see now that for folks who don't like using the slimmed down Series C documents, they will still use Series A style documents on the NVCA forms. They will just call it a Series Seed round, so they just swap out the Series A for Series Seed. That's a Series A round, right? So all the stuff we've been talking about before about how if you stick to the forms, you can do it, it can be relatively inexpensive and you have these sort of more slimmed down features. That's not really going to be the way that those sorts of rounds work, but that's okay. Again, I think it comes down to, what are the investors going to require when you're looking to raise a seed round, keeping in mind that the main benefit of doing a priced equity round is to, know exactly how much of the company you're giving away. We've also included a link here to Fenwick and West VC survey, which we put out quarterly. This is widely read throughout the country, and it gives a way for us to see, how the sort of negotiating dynamics are shifting between companies and VCs, and to also see, how much money is being raised in each sector.
Fantastic. Jonathan, thank you so much. And before we actually turn it over for some questions, because we did leave a few minutes at the end of the hour, I just wanted to make one final point or observation. This presentation, to me, it's obvious, and probably to most of you, it should become obvious, if not already, that this is pretty complicated stuff, right? There are lots of places where we can make errors along the way. And so we highly, highly, highly encourage you to work with counsel who is experienced and an expert in these areas, right? If you're ultimately going to go out for outside investment, you really want to work with attorneys. I mean, up until now, you may be using a local attorney to help that might have helped you get started. You might have some family or friends that are attorneys who's helping you out with some contracts and agreements and things of that nature, and that's perfectly fine. But this is, once you get to this level, you really, really, really want to work with an attorney who is well versed and can guide you through some of the decision-making process as you really look to kind of finalize a funding round.
Great. So, and thanks, Sirk. I always appreciate someone, plugging having a good lawyer, right? It's sort of my chosen career path. So thanks for that.
You guys all give Jonathan a call. Bombard him with your phone calls.
We have a couple of questions, if you don't mind.
Yeah.
So they ask, for friends and family, is it usually used as safe or just a loan?
Yeah. Thanks, Patty. I've gone through a lot of these, and so I'm happy to tick through them.
Perfect.
in the time that we have. So on the first question, for friends and family, is it a safe or a loan? There are times when people will borrow money, right? It's true debt. You have to pay it back from friends and family. Again, our view would be, don't take money from people who can't afford to give it to you. And that would apply just the same if someone's going to be just giving you a loan. But understood that everybody's trying to get a business off the ground, and sometimes you got to borrow money from a parent who may or may not have that money to give you. And I'm not suggesting that you can't be sort of pragmatic in this situation, but usually for friends and family, it's going to be a safe or a note, and it's going to be the sort of same principles that we talked about the round having all the same terms. It's just going to be, you're just going to be raising less money. I'm going to skip ahead a little bit in some of the questions, because I did deal with some of these earlier. So one person has asked if we can explain the role of a letter of intent, an LOI. So LOIs or term sheets, right, you usually don't get them for a safe financing, but they aren't uncommon for note financings. The benefit of an LOI or a term sheet is that if you're able to get a lead investor, so someone who's taking, ideally more than half of the round, but if not, is going to be the single largest investor in the round. So maybe they're taking 30% of the round, but everybody else is going to be super small. The benefit of a term sheet is you get to do all of the negotiation with one party, right? And you can finalize the term sheet and then build docs off of that. And then those docs don't really have to be negotiated all that much. And that's a way to save some time and some money. So we certainly suggest that going the term sheet route is a really good idea if you're raising a larger note round and you have a lead investor. Someone had asked, can we elaborate a little bit more on pro rata rights? So pro rata rights, they come in different flavors, but the basic principle is that the holder of the pro rata right has the ability to maintain their ownership interest in the company by investing more money in the company. It's a contractual right that they have. And so this, for many VCs and angel investors, is the most important right that they negotiate for in each financing. They want the ability to say, if I own 10% of the company, then from a round, then I get to invest more money in your next round to maintain that 10% ownership interest. Pro rata rights are fine for very large investors. They're perfectly customary. We just caution giving them out to sort of everybody because it then becomes very difficult to manage. And frankly, a lot of people may think they want them, but you don't need to have pro rata rights for the company to be able to go back to you as an investor and say, hey, we'd like to offer you the opportunity to invest in the round. It just gets difficult to manage when you have tons of people who have pro rata rights. One person is asking, shouldn't option pools, basically shouldn't you expand your option pool after the round is closed? In other words, why doesn't everybody, when you're negotiating with an investor, and we talked about this in option pool size, right? Why don't you just say to everybody, look, we're just going to approve the option pool after we close the round, and then it'll be dilutive pro rata to everybody. So that would be great if we could make that happen in deals, but it almost never happens because the market approach is that any increase in the size of the option pool is dilutive to the pre-money cap table for the reasons that I talked about before. Investors are focused on, I want to own the percentage of the company that I've negotiated for, and I don't want option grants, to be dilutive to me, knowing that when we get to the next round of financing, when we have an option pool increase, I, as an investor in the prior round, I'm going to get diluted by that increase. So yes, in a perfect world, as company counsel, we would love to see it, but it almost never happens because investors just don't tolerate it. For a drag along, a question that, is there any possibility of someone holding out if they're subject to a drag? The whole reason we put a drag in place is so that, we try to avoid that risk. So if it's properly drafted and if the deal fits the drag terms and doesn't fall under some sort of exception where the drag wouldn't apply, then yes, the idea is that nobody has any holdup value because you trigger the drag along and they have signed a contract that said they will vote in favor of the transaction. So the next thing that I'll talk about is there's an interesting question on data room hosting. I'm sort of agnostic on this. People use law firm data rooms, which is fine. People use Dropbox or Box or Google Drive. It's really about, being organized and responsive to a diligence request list, I think is much more important necessarily than the service provider that you're using. The only thing to be concerned about is to make sure that you can monitor who has access to your documents. I think the last question I'll answer is, there's a general question about, are you better off using, a full service law firm or one of the online service providers that's available for formation or for, any of your legal needs. Look, you can use whoever you'd like. Full service law firms are different value propositions. And, for people who are in a position where it makes sense for them financially to be able to take advantage of all the services that a firm like Fenwick can offer, I obviously think it makes the most sense in the world. But, for a firm like Fenwick is really built for companies who are looking to raise venture financing and are looking to scale rapidly. Like every aspect of our firm is really built for that. But that doesn't mean that we're right for everybody. And that's true for lots of large law firms. So it's really all about finding somewhere that you think makes sense for your business, basically for the stage that you're at. That doesn't mean we don't do formations. I form a few companies each month. But there are lots of other service providers out there at mid-sized firms or smaller firms or some of these online resources that are perfectly suitable for people.
Perfect. Thank you, Jonathan. Thank you, Sirk. Once again, everyone, thank you for attending the webinar. Jonathan, if we have some more questions, can we email you directly, or is there a better way to reach you?
Yeah, no, that's fine. I'm certainly happy to speak with people, and you're welcome, to email me directly and see if we can get on the phone.
Perfect. Thank you, everyone.
Thank you,
All right,
everyone.
thanks, everybody.
Appreciate your time.
All right, bye-bye.
Bye.